The moment you treat the market as an opponent, you have already lost. The market is merely a mirror reflecting your own discipline. We are here to talk about the final, catastrophic stage of emotional breakdown in trading. The single impulse responsible for wiping out more accounts than leverage, volatility, and bad analysis combined. We are talking about revenge trading. You know this moment. It is darker, colder, and far more lethal than FOMO. FOMO is the fear of missing out on a gain. Revenge trading is the desperate need to instantly recover a loss. The event is simple. You took a small, calculated loss. It was part of the plan. You exited. You were disciplined. But that loss, it left a scratch on your ego. It left a hole in your capital. It registered not as a business cost, but as a personal insult. And then the fever starts. You immediately begin scanning the market, not for a high probability setup, but for a guaranteed winner. You search for the fastest way to get your money back. Your analysis becomes aggressive. Your position size increases. Your patience vanishes. You hit the button, not with the conviction of your edge, but with the desperation of debt. You are no longer trading to build wealth. You are trading to undo the past. You are trading to prove to the market and to yourself that you are not a loser. This, my friends, is the cycle that takes a disciplined 1% loss and turns it into an account-crippling 20% drawdown in under 1 hour. This is the revenge trading cycle, and our mission today is to break it permanently in one day. The psychology of the attack. To defeat revenge trading, we must diagnose its origins. It is rooted in two deeply destructive cognitive errors that turn you from a professional operator into a compulsive gambler. Error number 1: the market as an opponent. The first error is the personalization of the loss. When you lose money, your primitive mind sees it not as a statistical event, but as an attack by the market. You perceive the market as an enemy that has intentionally stolen your capital. This framing is fatal. When you view the market as an opponent, you stop being an objective decision maker. You become an angry combatant. You engage in a fight that you cannot win, because the market is not a person. It is an indifferent machine governed by physics and probability. It has no memory. It has no malice. But your brain tells you, you must retaliate. You must restore justice. This emotional imperative drives you to violate every rule of risk management. You believe a bigger trade, taken quickly, is the only way to re-establish control. This is the ultimate illusion of control. We must internalize this truth now. A loss is simply a fee paid to the market for the statistical information required to find your next winning edge. It is a cost of business, like rent or insurance. It is not an attack. Error number 2: the sunk cost fallacy. Revenge trading is the ultimate manifestation of the sunk cost fallacy. This bias states that you should continue in action because of the previous resources you have already invested. You are chasing not a future profit, but the recovery of past capital. The money is gone. It is a sunk cost. It is irretrievable from that specific loss event. But your mind convinces you that if you just trade enough, big enough, or fast enough, you can somehow travel back in time and recover the initial loss. This fallacy forces you to take on new, unacceptable risk to salvage an old, finished problem. You are risking $10 today to recover the $2 you lost yesterday. This violates the core rule of compounding returns. The professional always optimizes for future profitability, never for past recovery. The 3 stages of collapse. The revenge trading cycle is not random. It follows a predictable 3-stage collapse. Identifying the stage is your first defense. Stage 1. Emotional shock. This occurs immediately after the stop loss is hit. The dominant feelings are shame, anger, and betrayal. The adrenaline spike is massive. During this window, the trading instinct is purely reactive. The mental voice is saying, "That stop was too tight. I was right. I must prove it now." This is the most dangerous stage. Any trade taken here is a guaranteed gambling error. It is emotion overriding logic at its most powerful.
Stage 2. Strategic justification. The initial rage settles, and the mind attempts to rationalize its impulsive urges. You start looking for a new, secondary setup that proves the primary loss was an outlier. You selectively read news headlines, you adjust your indicators, you stretch your rules to fit the desired trade. You are not searching for truth. You are searching for permission to gamble. The mind is saying, if I just double the size, this will erase the first loss and put me back ahead. It's a clean slate. This is the mathematical lie that destroys capital. You are manipulating your data to fit your emotional need. Stage 3. Capitulation. This is the trade you knew you shouldn't take. You enter with an oversized position, a wider than normal stop, and a desperate hope. The trade quickly moves against you, confirming the statistical improbability of your impulsive move. The drawdown is massive, forcing you to take an even larger, more painful loss, or leading to an emotional freeze where you hold the loss indefinitely. This third stage is not about recovery. It is about account liquidation. It is the moment the amateur admits defeat by the market because they first admitted defeat to their own psychology. Your immediate, non-negotiable lockdown. To stop this cycle in one day, you must implement an immediate physical solution to stage 1. The moment your stop loss is executed, regardless of the size of the loss, you must activate the 5-minute firewall. This is not a suggestion, it is a compulsory, non-negotiable emergency protocol. Number 1. Hands off. Physically move your mouse and keyboard out of arm's reach. Stand up. Number 2. Verbalize the acceptance. Speak out loud. The trade is over. The capital is gone. This is a business cost. Number 3. Physical disruption. Move away from the screen for a full 5 minutes. Do not check your phone. Do not check the chart. Focus on a completely different sensory experience. Stretch. Drink water. Look out a window. This 5-minute separation is the critical circuit breaker. It allows the initial adrenaline spike to subside. It moves you past stage 1 before you can hit the button. It prevents the emotional shock from immediately transitioning into destructive action. If you cannot honor this 5-minute firewall, you cannot be trusted with the capital. It is the first test of your commitment to profitability.
A loss is only a negative event when it teaches you nothing. A managed loss is tuition paid for the next profitable lesson. The 5-minute firewall provides the critical separation you need to survive stage 1. But to break the cycle permanently, we must address the root cause, the personalization of the loss. You treat the market like it owes you something. It does not. We must implement the protocol of depersonalization. This is the process of converting a painful, emotional event into a sterile, objective data point. The Objective Loss Review Scribe. The key to depersonalization is immediate, formalized documentation. You must force yourself into the role of an objective observer, a scientist, rather than the angry participant. The moment your 5-minute firewall is complete, you must immediately open a blank document and become the Loss Review Scribe. you will follow these 3 mandatory steps. Step number 1, the factual transcript. You must record 3 facts about the trade you just exited. No emotion is allowed, only data. 1. The entry data, the exact time, price, and primary technical reason for entry. Example, 10:30 a.m., entered at 50.00 on a confirmed breakout of the 50-day moving average. 2. The exit data, the exact time, price, and reason for the exit. Example, 10:45 a.m., exited at 49.50 due to programmed hard stop loss hit. 3. The capital result, the exact percentage loss relative to account equity. Example, net loss was 0.5% of total capital. By focusing purely on the transcription of data, you force your mind to recognize the loss as a simple transaction. It is history. It is a data point. It is not a failure. Step number 2, the rule compliance audit. This step isolates the trade result from the trade process. You must ask a single crucial question. Did I follow my written trading plan? There are only 2 possible answers, yes or no.
If the answer is yes, the process was successful. The result was simply part of the expected statistical distribution of your edge. You must immediately praise your discipline. The trade was a win for your process, despite the monetary loss. You must record, process was compliant, discipline maintained. If the answer is no, the process was the failure. The loss was a direct result of deviating from your edge. You must record the exact rule violated. Example, violation, position size was 1.5 times maximum allowable. The failure is not the market's fault. It is a mechanical error. This audit separates the process failure from the random outcome. Revenge trading only happens when you confuse the 2. Step number 3, the next move protocol. Do not allow your mind to linger on the past. Your attention must be immediately redirected to future profitability. You must commit to one of 2 actions for the next 60 minutes. Action A, exit the session. If you have taken 2 consecutive non-compliant trades, or if the process audit revealed a failure in rule following, you must immediately shut down your trading platform and walk away for the remainder of the session. You have established a psychological leak that must be repaired before risking more capital. Action B, refocus on the next setup. If your process audit was fully compliant, you are cleared to continue. But before you look at another chart, you must identify and write down the single highest probability setup you are now searching for. You are resetting your target laser. You are forbidden from looking for the revenge trade. You are only looking for the next statistically valid setup. The ritual of cleansing. The revenge cycle feeds on emotional attachment to capital. We must perform a ritual of cleansing to sever that attachment. After every loss that triggers a review, you must physically move the capital into a different mental bucket. This is not literal, it is psychological. Imagine you have 2 accounts, the risk capital account and the tuition fee account. The moment the loss is incurred, you acknowledge that portion of capital has moved from risk capital to tuition fee. You paid the fee to gain the statistical information you just recorded in your scribe. You cannot get tuition money back. You can only use the education it provided to earn more in the future. By performing this ritual, you accept the loss as non-recoverable, non-personal, and completely necessary for the ongoing education of your trading mind. You have paid the fee. Now you must apply the lesson. This depersonalization protocol is your armor. It shields your ego from the inevitable pain of losing and forces objectivity, ensuring the market's randomness cannot infect your discipline.
Control your exposure to the market, and you control your exposure to your own weakness. We have diagnosed the attack and instituted the objective review protocol.
Now, we install the tactical circuit breakers, physical, immediate changes to your environment and process that make revenge trading mechanically impossible to execute. Revenge trading is always about two factors: speed and size. We must attack both. Circuit breaker number 1, the size lock. Revenge trading is often characterized by a position size that is 2 to 3 times larger than normal, an attempt to recover the prior loss in a single, high-risk trade. We must physically eliminate this option. You must install a size lock on your platform. This is a written rule physically taped to your monitor that forbids you from entering a trade with a capital risk exceeding your standard 1% or 1.5% per trade. But the real power comes from the mental cost threshold. Before you click the entry button on any trade, especially after a loss, you must calculate the absolute dollar amount you would lose if the maximum stop was hit. If your standard 1% risk is $500 and the revenge trade would require a $1,500 risk, you must ask yourself, am I willing to take 3 compliant winning trades just to recover the loss of this one impulsive entry? When the numbers are forced to be real and present, the impulsive urge retreats. Revenge is all about 2 factors: speed and size. We must attack both. Circuit breaker number 2, the one trade maximum. If you have experienced a loss, you are immediately limited to a one trade maximum rule for the next hour. This means you are only allowed to enter one new trade after a loss. If that trade is also a loss, even a small, compliant one, your trading session is immediately over. This rule is a powerful governor on the emotional engine. It acknowledges the fact that psychological capital is depleted after a loss. Your mental stability is a precious resource. If you are forced to make that single next trade count, your focus naturally sharpens. You will only select a true A+ setup. You eliminate the cascading effect, where one loss leads to 2 bad trades, which leads to 4 trades taken in a fit of rage. The one trade maximum provides a structured, graceful exit. If the second trade fails, the day's total loss is still controlled and manageable. You have preserved 80% of the capital that a revenge cycle would have destroyed. You have ensured that the maximum damage for the day is strictly defined. Circuit breaker number 3, the platform kill switch. The ultimate weapon against instantaneous emotional relapse is the platform kill switch. After any loss that exceeds your standard tolerance level, say a loss that is 2 times the normal size due to slippage or poor initial sizing, you must have a physical process to remove the possibility of further action. This is not just closing the charts, it is logging out of your trading platform completely. Better yet, it is shutting down your trading terminal. The professional trader creates friction between the emotional impulse and the trade execution. If you have to spend 5 minutes logging back in, reloading your system, and entering passwords, that friction is usually enough to kill the impulse. The emotional urgency cannot survive the mechanical steps. This is a physical barrier against a psychological meltdown. Your environment must protect you from your weakest moment. If the platform is closed, the button cannot be pressed. Simple, effective, non-negotiable. The trade-less profit. Every time you respect the platform kill switch and log out, you are securing a trade-less profit. You are guaranteeing that the maximum loss for the day is capped. You have moved your account from a state of unlimited downside risk to a state of defined, controlled loss. Your job is not to win every day. Your job is to survive every day. The ultimate profit is not the gain you make, but the devastating loss you avoid. The tactical circuit breakers ensure that you survive the emotional attack of revenge.
The true professional manages risk, not price. The amateur chases profit, but the master protects capital. We have established the defense and installed the tactical protocols.
We now address the deepest change required to permanently break the revenge cycle: the mindset shift. You must stop viewing yourself as a trader and start viewing yourself as the CEO of risk for your own financial fund. A CEO does not get angry at a quarterly loss. They analyze the data, fire the process that caused the deviation, and reallocate capital to the most profitable divisions. They view losses as data points for optimization, never as personal insults. The 3 commitments of the risk CEO. To enforce this mindset shift, you must adopt 3 new commitments that fundamentally change your relationship with volatility and loss. Commitment number 1, the acceptance of statistical distribution. You must accept that every time you enter a trade, you are executing a high-probability system with a built-in rate of failure. If your system has a 60% win rate, 40% of your trades must be losses. They are necessary components of the system. The revenge trader fights the failure rate. The risk CEO embraces it. When you take a loss, you should confirm that you are on track with your statistical edge. You can even say, "Thank you, market, for confirming my statistical edge by delivering a necessary loss." A loss means your system is working. A loss is merely the space between 2 winners. By accepting this statistical reality, you eliminate the emotional shock that triggers revenge. There is no personal attack, only the continuation of a predictable pattern. Commitment number 2, the future risk focus. Revenge trading is rooted in looking backward. It's an attempt to fix yesterday. The risk CEO only looks forward. Your entire focus after a loss must shift from the monetary deficit to the future opportunity cost. Ask yourself, by taking this revenge trade, what statistically superior trade am I risking my capital on next week? Your capital is a finite resource. Every impulsive trade consumes capital that could have been perfectly deployed later. By focusing on future opportunity preservation, you elevate your decision-making from the emotional now to the strategic future. You are protecting the integrity of your compounded growth. This principle is the cornerstone of professional fund management. They allocate capital based on forward-looking risk models, never based on trying to undo the last deviation. You are your own fund manager. Adopt the same discipline. Commitment number 3, the defined daily loss cap. This is the ultimate expression of the risk CEO mindset. You must define, in writing, the maximum percentage loss your entire account can sustain in one single 24-hour period before all trading is instantly and automatically suspended. This cap should be small, perhaps 1.5% or 2% of your total account value. When this line is crossed, the decision is not emotional. It is mechanical. The CEO has instituted a shutdown protocol. This limit removes the possibility of capitulation. You cannot take a catastrophic revenge trade because the system has been programmed to stop the machine before it self-destructs. This limit is the ultimate tool for breaking the cycle in one day because it guarantees that no matter how angry or irrational you become, the damage is capped and manageable. You are forcing guaranteed survival.
Your success in trading will be directly proportional to the distance you create between your emotion and your execution. We have walked the full path. We have confronted the emotional core of revenge trading, installed the protocols of depersonalization, and adopted the strategic mindset of the risk CEO. To achieve permanent mastery and break the cycle forever, you must integrate these concepts into a single, cohesive daily ritual. This integration is your final commitment. The daily zero-state ritual. Every morning, before you execute your first trade, you must enforce the zero-state ritual.
This is a 2-minute mental exercise designed to clear your mind of yesterday's baggage, both the wins and the losses, to ensure you start today with a clean slate. Zero State Action 1, the Sunk Cost Declaration. Verbally declare, yesterday's profits are gone, yesterday's losses are gone. My account is reset to a statistical zero. Today, I am only trading the present probability. This declaration severs the emotional link. It prevents the arrogance of a big win from leading to an oversized risk, and it prevents the shame of a loss from leading to revenge. You are always starting fresh. Zero State Action 2, the Risk CEO Mandate. Review your daily loss cap and your maximum per trade risk. Reconfirm your size lock. Verbally state, my primary mandate for the day is capital preservation. My secondary mandate is the execution of the high probability edge. I will prioritize discipline over profit. This mandate enforces the future-focused, objective mindset. The final, non-negotiable commitment. Breaking the revenge cycle is not a one-time event. It is a single, unwavering commitment to self-trust. If you cannot trust yourself to honor the 5-minute firewall, if you cannot trust yourself to log the loss objectively, if you cannot trust yourself to abide by your own daily loss cap, then you are unfit to manage trading capital. The only way to earn that trust back is through flawless, repeatable process execution. Your journey to breaking the revenge cycle in one day begins the moment you take your next loss. That loss is your final examination. Will you fail by chasing your capital, or will you pass by executing your protocol? The market will always be volatile. The market will always present temptation, but your internal system, your mind for trade, must become impenetrable. Do not trade to get rich quickly. Trade to get rich consistently. The tools are here. The path is clear. The commitment must be yours. If you're ready to enforce this discipline and dedicate yourself to the mastery of trading psychology, if you are ready to transform from an emotional chaser into a calculated and profitable CEO of risk, then I urge you to make this final commitment permanent. We are here to help you build that fortress around your process. We are here to help you make failure impossible and success inevitable. Commit now. Commit to the system. Commit to your future self.